All back from holidays to the same old flat market. Today it was the same pattern as it's been for months. Retailers down, Telstra up, banks and big miners sideways. Over the past 12 months actually, JB Hi-Fi shares have fallen nearly 40% and Telstra is up more than 20%, a difference of a staggering 60%. That's a reminder that the All Ordinaries is an average of some very different things. On the subject of retailing and mining, here's a graph that divides today's retail sales figures into mining and non-mining states. And that's two speeds, all right. Although the question is, of course, how long China will continue supporting the boom in the mining states. And on that subject, I've got to say this chart surprised and scared me. It's a Chinese real estate index, down 34% since last June, and if anything, the slide is accelerating. I seem to remember something like that happening in the United States in 2007. The Chinese share market actually was the only one to go up in Asia today, the rest fell, and that followed moderate falls in the US and Europe on Friday. Now, as well as retail sales, there were figures today on new home sales for November, up quite strongly. Although, as the HIA's economist said, after an 11-year low in September and a rate cut in November, no recovery would have been very disturbing. The Australian dollar slipped back below 102 US cents after the retail sales numbers hit the foreign exchange screens this morning. And finally, amid all the gloom, something that might bring a smile to your face, the Wall Street Journal says the bankers at Goldman Sachs in New York got a pay cut in 2011, although they're still looking at an average of $385,000. Not exactly Struggle Street. And that's finance.